Back prior to the election, I actually did a workshop that may look familiar to some of you that actually saw it, which was about the election upcoming. And a lot of things that I said in that workshop ended up coming to fruition. But one of the things I want to do is I want to revisit that. And I'm going to add some things to the workshop that I think are really important right now, because we've been getting a lot of questions, people asking me all the time, hey, Paul, what do you think now? Changes in Washington. Now what? I changed the name of it because of that. So when I talk about elections and markets, elections can affect markets. You got candidates, you got people that are in fear and they're worried about what was going to happen, what is going to happen, what the next 4 years is going to be like. And I'm going to talk about changing your lenses. Have we been here before? Talk a little bit about how markets price elections and how that happened over the past several months. And socialism, people talk about socialism. Are we going to socialism? Are we going to communism? I'm going to talk a little bit about that, talk about presidents and markets by party, talk also about stock market predictions and how they did at predicting elections and how markets work in general. What really matters, so we're going to go through a lot of territory here. Some of it I've visited before, but it really needs revisiting. If we looked at the election, we had Democrats, Republicans, Biden, Trump, and predictions were all over the place. At that point in time when this whole thing was happening, there was this whole thing about how if Biden gets in, there's going to be a stock market boom. And there was a lot of people saying, no, it's going to be a disaster. It's going to be terrible for the stock market. The market's going to crash. Now, of course, what happened? The market went up. It went up after the election results came in concert with the vaccine announcement. So you have both of those things. But it has continued to go up even with vaccine announcements and some of the things that are coming out regarding how markets are likely to be affected by the new presidency. But, back to some of the predictions, you'd be scared out of your pants that it was terrible. It was going to be awful. Biden presidency could recharge the stock market, said some, but some people were saying, no, it's going to be terrible. It's going to be brutal for the stock market. People will start unloading stocks if it looks like Biden will defeat Trump. But my favorite headline was really this one, which said U.S. stocks rise regardless of Trump or Biden win. And the reality was that Trump was a known quantity. Everybody kind of knew what he stood for, what he was going to do. Nobody really knew what Biden stood for, what he was going to necessarily do. So people talked more about him because he hadn't been there. He wasn't president. So we didn't know how he was going to act or what he was going to do. So now we've got to say, hey, what do we think he's going to do? And price stocks based on that. If I'm buying, I don't want to pay too much. If I'm selling, I don't want to sell it for too little. So we generally fear the unknown. And we tend to be very nervous about things that we don't know about or we don't understand. And that is just human behavior. Now, this worry that as a result of this it's a trigger. And what happened, the trigger was the election. And we get these what if questions that came to people's minds. And people would ask, well, Paul, what if Biden raises taxes? What if we have martial law? They had that, what was it, last week, I guess. There was a guy, it was on Sunday. He said, we're going to have martial law. I heard it from inside sources, blah, blah, blah. And it's going to happen by Wednesday. And I was talking to a friend of mine, and I says, you know what the great part was? Is the person said it was going to happen by Wednesday. So can we just get this out of the way if by Wednesday this hasn't happened? It was like that whole thing with the Hindenburg omen. There was a big talk show host, major talk show host that actually said the Hindenburg omen, and 80-90% of the time when this happens, the stock market goes down and blah, 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 and people are all scared about it. So I did a video about it. I said, this is nothing but data mining. It's a bunch of hogwash. And boy, I got some hate emails and hate comments on the video. It was terrible. People did not like me when I said that about this prediction. Well, a couple months later, I said, well, just watch. We got a couple months. This is supposed to happen in the next couple of months. Well, a couple months later, what happened? Didn't happen. Stock market went straight up. Now, I jokingly said, well, what would have happened had the market gone down? Because three out of 4 years, the market goes up. 1 out of 4 years, it goes down if you're well diversified. And I joked, well, I wouldn't have done a video. But the reality of it was, I didn't know what it was going to do, but I had a 3/4 shot of being right if I said that it could go up. And I said that in the video. It has a 1/4 shot of going down, but this is data mining. And what happens, people are always trying to predict the future in this way. What if gas prices skyrocket? Well, if they do, that ushers in a faster move toward alternative energy sources. There's all kinds of talk about who the next Tesla is going to be. The battery companies coming out with new things. It's fascinating to me how with COVID, you all of a sudden had a move much faster than anybody thought was possible toward actually using technologies like Zoom, or where you could actually go and have meetings with people from across the country. You have companies that are letting their employees work from all over the country, even though they might be located in California. They're living here in Tennessee, avoiding the California taxes, working because they can because of technologies like that. Well, what made us actually implement those technologies much more rapidly? Literally a virus. So the thing is that you say that necessity is the mother of invention. That's exactly what it is. We have these technologies that come about much more rapidly when we need them. And if gas prices go up, I don't worry about that. We'll actually go and move to the new technologies where they're talking about hydrogen cars. That person from the local university that took a car all the way across the United States using just hydrogen. So there's a lot of things they come about. So I don't necessarily worry about those types of things. And then you go, well, what if they change the Supreme Court? And what if fair elections are a casualty and we don't have fair elections anymore? And there's just a lot of people that are worried about all kinds of things. Well, worry leads to anxiety, and it leads to demoralization and exhaustion. And what happens is, we see these bad things that can happen, and our temptation is to do something. Let's take action. And there was a funny article I was sharing with the guys today. It was Fidelity reviewed which investors did best, and what they found was hilarious. What they did is they went out and looked at investment performance. Now, this is a company that engages in a lot of active management, a lot of buying, selling, stock picking, and market timing. But the funny thing is this. They had these people that they looked at and they said, well, why do these people have higher returns than everybody else? Well, I'll read you the transcript. It says, O'Shaughnessy relays one anecdote from an employee who recently joined his firm that really makes one's head spin. O'Shaughnessy: Fidelity had done a study in which accounts that had done best, and what they found was, and the other guy goes, that they were dead? This is, no, but that's close enough. They were the accounts of people who forgot they had an account, which is hilarious. You think about it. If you forget that you have an account, you're not tempted to try to figure out if the market's going to go up, it's going to go down, which stock is going to do better than others. Kind of funny when you think about it, because that's what we think of as being the job of the investment manager, is doing all of that stuff. And that is not the job of an investment manager. It's a workshop for another time. But anyway, so we're tempted to take action. So uncertainty is the worry fuel. If we're intolerant of uncertainty, this came from this was a psychologist I was checking out one day on the internet, and I loved what he had to say. He says, when we're intolerant of uncertainty, we tend to worry a lot. So he said that there are two approaches to life. And one is that we might have a tolerance to uncertainty. We might be that person that says, I'm taking a trip to Europe, I'm taking a one-way trip, one-way ticket, I don't have any money on me, no credit cards, no plans, I'll figure out what I'm going to do when I get there, I don't know when I'm going to return, this is going to be great. Then you have the other person that says, I'm taking a trip to Europe, I know exactly when I'm going, I know when I'm coming back, I have my cash, my credit cards are all set, even if it rains, I know what I'm going to do on the day that it rains, and I'm ready. And what happens is we have lenses. When we're intolerant of uncertainty, we tend to have these lenses that we wear, so to speak. And we tend to look at life in one of three ways. The first way would be, let's say that I think that, if something uncertain happens, it's going to be bad. I think things are going to go wrong. There's going to be a bad outcome. So we have that negative outcome that on our mind. Now, there may be another alternative, though. If you think about it, it might be neutral. It may not be good or bad. It might be just a neutral outcome. Now, there's a third one that often never crosses our mind. If something uncertain happens, it may actually be for the better. It may actually be good. And what we do is this. In elections, we fear the worst case scenario. oh, there's going to be an increase in taxes, an increase in regulation, and it's going to alter the Constitution, we're going to alter our rights, we're going to crash the stock market. And it's interesting because the Wall Street Journal today had an article that was talking about what's on Biden's business and economic to-do list. Well, mainly what's on his list is focusing on the pandemic and stabilizing the economy. Everything else is on hold. Basically, it was saying, talking about tax increases. I heard somebody on TV today saying it's not on the radar to actually do anything with taxes right now. Now, if they do raise taxes, is it the end of the world? Not necessarily, because what are companies really, and that's what we own when we own stocks, what are companies really good at? Avoiding taxes. What do they do? What do they do? In the last administration, they had corporate inversions, which means that they would go and let companies from outside the U.S. buy them. And that way they avoid U.S. taxes. The other thing they would do is they'd lend money to each other. Company A lends Company B money, and Company B lends Company A money so that they don't have to pay taxes, bringing money back to the United States. So companies figure out ways. What if they change regulations and they increase costs? Well, they'll lay off people. I hate it for the economy, but they will do whatever they've got to do to get the bottom line up, which is profits. What if the economy slows down? Well, they're not selling stuff, so they'll stop buying things for the raw materials for the products that they sell. They'll reduce their costs that way. Companies will always adapt. You think about it. So, I don't worry about market crashes or anything like that. They're temporary. If they happen, they're temporary. And on average, from 1940s until today, the average amount of time it takes for the market to completely recover from downturns, about 111 days. It's not very long. Now, sometimes it's taken longer for markets to recover, a year, 2 years. But the reality of it is sometimes it's way shorter than 111 days, and sometimes it's a little bit longer. So if we look at history, we can see that we've gone through some stuff, more on that in just a second. And we've always recovered. Why? Because we can control sales and we can control our expenses as a company. Now, it's easy to let our imaginations run wild when it comes to worst case outcomes. We go, oh my goodness, we're going to have more government, and that's going to lead to socialism. It's going to lead to communism. And what also happens is that we run to conclusions and we come to the conclusions on what happens if Biden wins. It means that taxes are going to skyrocket, and people were worried about the businesses will fail and companies will leave. And it's interesting because you think, well, if you knew that he won back in November and December, that should mean that he won, so the stock market should have gone down. It went up. Why? Well, maybe our conclusions or what he was going to do was already built into markets before the election happened. Maybe. So you think about that and you go, wow, maybe things aren't as simple as I make them out to be. We were worried, that people were worried that stocks would crash and that you'll lose everything. You'll be living under a box, under a bridge in a box or something like that. Now, the question that I like to bring up to people is, people always say, well, it's different now. Everything's different. Everything's different from the way it was back during the previous administrations. And my point is, no, things are not different. There was a guy named Alf Landon. He was running on the idea that Social Security was going to be a huge debacle. It was going to be this huge federal program that was going to destroy the economy, and it was going to destroy companies. It was going to be terrible for America. Now, the concerns were that we'd have socialism, and the government had the right to tax employees, and employers, it was unconstitutional. And basically, here's what the guy had to say.
This is the largest tax bill in history. And to call it Social Security is a fraud on the working man.
And we're going to take your money out of your paycheck and you have no say over it. Well, what happened is the Supreme Court came in and says, no, this is actually constitutional and this can be done. Now, there's nothing new about socialism fears. Roosevelt was criticized for his economic policies, especially good grief, you still hear about it. How, FDR, it was, socialist and communist, and von Mises wrote about the New Deal was a replica of Otto von Bismarck's social policies. Milton Friedman says that Bismarck Germany influenced the New Deal, and Friedman said that Germany's aristocratic and autocratic government, left-wing governments had a paternalistic philosophy. That was the government was going to take care of everybody, and this was going to be terrible for the economy. This is going back to the 1930s. We'll look at what happened in the market since the 30s in just a second. Now, my job isn't to sit here and talk politics, as I often say. It's just to talk about markets and investing, how markets work. If you look at when Social Security was passed in 1935, what happened to the growth of $10,000 across the board, it was significantly positive for both large U.S. stocks, microcap stocks, large value stocks, and small value stocks. And so it actually ended up being very, very good for the next 10 years. This is 10 years worth of data that you're looking at behind me. Now, we go to the 1960s. We had all kinds of opposition to Medicare. Medicare was going to be terrible. And here's what they had to say about Medicare.
Ladies and gentlemen, this King Anderson bill is a cruel hoax and a delusion. It wastefully covers millions who do not need it. It heartlessly ignores millions who do need coverage. It is not true insurance. It will create an enormous and unpredictable burden on every working taxpayer. It offers sharply limited benefits. It will undercut and destroy the wholesome growth of private, voluntary insurance and prepayment health programs for the aged, which offer flexible benefits in the full range of an individual's needs. It will lower the quality and availability of hospital services throughout our country. It will stand between the patient and his doctor. And it will serve as a forerunner of a different system of medicine for all Americans.
So it's going to be terrible and awful. And, decide for yourself whether you think it's good, Medicare is good, or whether it's bad. I'm not here to say which one it is, but the point that I would want to make is this, that companies adapt to whatever is thrown at them. Look at the stock market from that point, from when Medicare was instituted till now. Large, small, large value, small value, all the markets up significantly over that time. A really large emphasis on significantly over that period of time. Now, if we look at the effects of socialist policies on the stock market, and we look at the market, how the market takes this information and brings it to bear, you may think that, you look at it and say, I think that socialist policies will slow the growth of the economy. And the reality is, you may be right. It might slow the growth of the economy, but this already gets incorporated into stock prices. What we find is that stock markets actually price in everything that's going on, and what could happen and what might happen is in current pricing. So everything that might happen in the next 4 years, you can think of it, it's already in the mix. It's too late to go and make any changes based on it because it's already in the pricing. Now, the reality of it is that if we look at various countries that are more socialistic than the United States, or where we have more socialism based on a study of economic freedom, you see something interesting. That in some areas, returns where there is less economic freedom, returns have actually been higher in many markets. If you look at this right here, it's really interesting. I did this in the last workshop, but like I said, it bears repeating. All of these countries would be looked at as being more socialistic than the United States. Canada, France, Japan, UK, versus the US would be more socialistic. And you can see it on this graph. Social assistance, there's more of it in Canada, France, Japan, and UK. Income tax credits, more of it in those countries. Housing benefits, more of it in those family benefits. In every area, these countries have more socialistic systems than the United States does. Let's take a look at annualized return from 1993 through 2020. And you notice that in this particular period of time, the US had slightly higher returns than those other markets. Much of it, though, think of it, is during a period in time where the US became more socialistic. And it actually, the US caught up in our thinking with some of those other countries. If we look at from 1970 through 1989, where there was more free market mentality in the United States, you actually see a different picture. U.S. returns, which is the first bar in this chart, actually were lower than other areas. How could that be? Why would that be? Well, the reason is actually that if you think about it, if there's more risk, in other words, when we have more government intervention, there's more risk, investors demand more returns. It's the opposite of what we think. We think, oh my goodness, more government intervention, lower returns. Not necessarily. And you look at the whole period of time, the returns between various market segments are very similar no matter where you are. Now, if we look at returns in terms of presidential terms, returns from the 1920s until today, based on what president was in power, it's pretty interesting study. Herbert Hoover, you notice, he brought us right into the Great Depression, and we had terrible returns. Markets dropped. Republican president, markets dropped significantly. Why? All kinds of possible reasons. Number one, there was tariffs that were being imposed at that point in time. How the Federal Reserve handled interest rate policy wasn't so great. Tax policy wasn't handled properly. They actually increased taxes versus decreasing taxes, increased interest rates versus reducing interest rates. So there were a lot of reasons that we had negatives. But bonds were about the only thing that went up during his presidency. Then Roosevelt came in. Significant positive returns in the stock market with Roosevelt, who was a Democrat. And then you get his second term, again, positive returns. Then we went into the World War II, and we had a negative at the first part, but then the returns during the war were really good. Why? Why were returns so good during World War II? Well, if you think about it, we were having companies make airplanes and tanks and ships, and they were making profits putting out what the government needed to fight the war. So companies adapted to what the new circumstances were and found different ways to make profits. And then you look at 44 through 1948, again, positive returns. Look at Harry Truman, positive returns. Look at Dwight Eisenhower, positive returns. And Republican, positive returns, Dwight out in his next term. Then John Kennedy, significantly positive returns. And then Lyndon Johnson, Richard Nixon, kind of tough period of time. Why? Because we went into the oil crisis years. Now, back in the oil crisis years, it was interesting because we were running out of our energy source. It affected everybody. But what we did, which was really interesting and led to, after Nixon's presidency, some pretty good significant positives, was that we figured out how to drill for oil, not just down, but sideways. So they figured out horizontal drilling. We got our energy source back. Companies adapted to the new circumstances. Then Ronald Reagan, very positive. And we look at the returns during the Reagan administration, good. Very, very good for international markets in Reagan's second term. And you go, well, wait a minute. Reagan was a very U.S.-centric president. Well, international markets did really, really well in his second term. Just goes to show. George Bush, good across the board. International, not so good. Then Clinton, across the board, good. Then we have Clinton, second term, across the board, good returns. Then you have George Bush and especially international small companies, significantly good, and small value companies. And then you have the next period of time, which included 2008 and the big downturn. Matter of fact, the dead decade from 2000 through 2009, U.S. large stocks, no return. International stocks, international small value, tripled in value. Go figure. So why, when we invest, why do we invest both in U.S. and international? Hey, I don't know. Maybe the next several years is going to be not so hot for U.S. stocks, and it's going to be great for international because of changes in trade policy. Don't know, but that's why we diversify. If we look at small companies and large companies, they benefit from different things. Small companies will benefit more when you have changes, let's say, like some of the things that we're seeing. It's quite a good possibility that as we come out of COVID, some of these smaller companies that have been beaten down to some extent are going to benefit way more than the big companies. Matter of fact, there's all kinds of talk about going in and having some antitrust legislation against some of these bigger companies. Well, American investors tend to be enthralled with these bigger companies. That could be really bad if you have all of your focus on those bigger companies. You want to own the smaller companies. You want to own the value companies. During when we had the tech bubble burst, because we had technology stocks recently doing really well. Well, the same thing happened in the late 90s. Technology did really well. And then when that thing crashed, when that came crumbling down, there were a lot of areas in the market, believe it or not, that did just fine. Value stocks did just fine. Small companies did just fine. Like I just said a little bit ago, international stocks did quite well. So this is why you really diversify. You don't know what's going to happen, what's coming. Your goal as an investor is to be diversified amongst different areas of different markets so you have dissimilar price movement. I want to own things that don't move with each other. If we have a year like 2000 where large growth stocks do this, it'd be really nice to have value stocks that went the other direction. If we have a year like 2001 where large growth stocks went down 12% or more, it's really nice to have those small companies that went up 35%. So you get the idea. Sometimes they can move together. Markets will move together. And what happens is, like in 2008, everything moved together, but they came back very differently. When we went through 2009, you had emerging market stocks that, when large U.S. stocks went up like 28%, I think it was, emerging market stocks was over 100%. So we want this dissimilar price movement. And during the downturn, when the market was down, our bonds actually went up in value. That's why we own very safe, very secure bonds, for that very reason. Obama, good across the board, both terms. Trump, really only one area of the market did really well under Trump. It was large U.S. stocks, the first bar. Everything else, not so great really when you look at it. Now if we look at Democratic Republican returns, what we will notice is this. Returns in stock markets have actually been better in every asset category under Democrats almost. Now Republicans, actually you had international. Go figure. Who'd have thought that international historically would have done better? Now that didn't happen under Trump. International didn't do better under Trump. So even these kind of things, don't try to figure it out. You won't figure out what's going to do well going forward just because it is so unpredictable. There are too many moving parts. There's too many inputs to figure it out. And that's why investment managers, professionals, can't beat markets. It's because it's so complicated. There are too many things going on. And the reality of it is that everybody's trying. So you have all these different people trying to figure out what's going to happen, where are things going to go. And the reality of it is you might have somebody that's really smart, as one academic puts it. And he goes, but they're not smarter than the collective of all investors. They only know a tiny fraction of what can be known and what can be predicted. Now, one of the things I like to point out is that presidents don't make markets. Markets make presidents. Now, what do I mean by that? You may think that the president is going to drive what the stock market does, but the reality of it is, if the economy doesn't do well under whatever the president does, they're not going to get reelected, and the reality of it is that they want to get reelected. When we have a situation where a company does poorly and there are no profits, if there are no profits, there are no taxes. If there are no taxes, there is no government. If there's no government, there's no FDIC. I've heard people say, well, I'm going to take all my money and stick it into cash. And I go, well, why? Well, because I don't trust the government. Okay, who issues the cash in this country? The government. You're going to go stick all your money in the entity or an asset backed by the entity that you don't trust? That doesn't make a lot of sense. So the reality of it is, everybody really wants the same thing. We've got to have the economy do well. And it's interesting because people say, well, I don't understand how they come to the conclusions that they do. Well, you look at and you say markets go up under both Republicans and Democrats. And why? Because companies adapt to the circumstances. Now, if a leadership change, let's say if they come in and they change things and they cause economic damage, it won't be long before the leadership changes again. So what should we be doing? Focus on time horizon when you invest. There was a Nobel Prize awarded in economics for how to put together a portfolio based on maximizing expected returns for a given level of risk. And it's ingenious because it actually puts things together that don't move in concert with each other, studying correlations. So I want to put things together like bathing suit sales and winter coat sales that don't move together, and that reduces the volatility of the portfolio. Don't concentrate all your money as many people have been doing in one area of the market. You could be sorely disappointed if that is the area that actually crashes. What we want to do is prepare for the unknown by diversifying in various areas of the market. Large growth, large value, small growth, small value in U.S., international markets, and we want to do it in emerging markets as well. So we want to have all of these quadrants covered in our portfolio. The reality of it is that Wall Street does not do this. If you look at this chart right here of these portfolios put together by fund companies, and they actually put them together for you to retire at a certain date, you'll notice one thing that's really interesting. This style box up here actually points out that most of the money is in one area of the market. The most of it is in large companies. That's what investors typically do. They don't even realize it. When I study investment firms, their portfolios, when people bring them in, that's what I see over and over again. They chase performance and they tend to put money all in the area of the market that people are most familiar with, which is big U.S. companies, and it can be one of the most dangerous things you can do. Especially right now, if we look at that area of the market, it's way higher priced than any other area of the market. I'm not saying it's going to crash, but I'm saying it's very dangerous to concentrate your portfolio. Now, what we find from pension studies, what really drives returns? Is it market timing? No. Is it other factors like cost? No. Is it stock selection? No. What drives your performance of your portfolio is how you mix the portfolio between various areas of the market. We've got to get people, and this is what I always try to do, to get them to escape this cycle. I got to fear the future. I want to predict or forecast the future. What do? I go, well, what did well last year? What did well the past 5 years? Let's look at the 10-year track record of mutual funds when we invest. Worst way to invest your money, because you're investing with your eyes in the rearview mirror. The past will not be the future. It just doesn't work that way. So we don't want to use track record when we invest, but people do it all the time because it just goes with our instincts. I want to go away from pain and go toward pleasure. We get overloaded with information because every investment firm out there tells you that they're the absolute best at managing money. They all get awards for great performance, in different periods of time, which is kind of crazy. And what happens is our emotions of going toward pleasure and our instincts going toward pleasure and going away from pain and fear causing us to pull money out of the market at the worst times. Remember this thing. This study is really, really good, showing us that when they did a study of investors that did best, the best performing investors were ones that they forgot that they had an account. Keep that in mind. You forget that you have an account, you're not tempted to go and sabotage that account by pulling out at the wrong time or putting money in at the wrong time. People do it over and over again. They're breaking the rules of investing. Instead of buy low, sell high, they buy high and they sell low. Now, my website is strategically designed to help you stay disciplined. Now, I don't expect you to forget that you got an account, but the best thing that you can do is stay educated, because the more you understand what are you doing, why are you doing it, how does it work, how do markets work, how do you keep expenses down, the better. And right there, you've got the podcast. You can actually go and sign up for the podcast on my website. We got videos on there. You got the blog. The other thing that you have, you can go through the investor quiz if you want to remind yourself of what you need to know more about. Take the investor quiz, test your knowledge, and then you can read the playbook about relaxing about your money. If you're not a client with ours yet, read this thing. It talks about my story, it talks about my philosophy of investing. And my book, of course, is another resource that you can get out there, and it's called Confident Investing: Why Blind Trust is a Poor Strategy. So that's it. I hope you, no questions today because we're not doing an actual live workshop. Well, you can always ask questions. Actually, I'll put that back up. If you got questions, you can actually email us if you've got something on your mind. Or you can take us up on the 15-minute phone call on our website. That's for people, if you're not a client of ours. If you're a client of ours, come on in. We love to see you. We love to update the financial plan, and we'll be doing that during the course of the year, updating financial plans and answering lots of questions and talking about the future and controlling what we can. Our own actions. That's what we can control. We can't control what Washington does, but realize that companies will be controlling what they do in response as well. And their job is to always grow the value of the company. And we'll catch you next time.